Thank you so much. Thank you very much, Sean. Thank you very much, everyone. I'm glad to see everyone on this beautiful Wednesday. And we're gonna speak. Today's class will be a subject that which is very dear to me, and for someone who's very visual and I like to see things. I think the subject that we have is pretty timely, and it's a technique that I've used as far as strategies that I've used using candlesticks. So uh, basically, what tonight I'm gonna more focus on, rather than going to the basics of candlesticks, which is available everywhere. Most of you who do the trading, you do the charting, you're pretty familiar as far as the background and what works. So if you don't mind tonight, I'm gonna actually emphasize more about the things that I use. They've been, they've worked for me. There's about 25 patterns, but I don't use 25. I only use few, and I like to work that with you. So before I start, it really candlestick charting came to America in the mid 80s, and Steve Nissen in 1990, I think 204, wrote this book, Japanese Candlestick Charting Technique. And then he wrote another book, Beyond Japanese Candlesticks. So what he did, he went and actually sat down and translated all the Japanese uh, uh, writings and to come up with this the English version. So basically, what candlestick charting was used by rice traders, and it's a graphical movement of the price. So they would use something similar to candle, and what it does, it shows you what was the high of the price in the trading and the rice, what was the low price, what was the opening, what was the closing. And it is credited to Manihisa Homa, which, 1800s, but according to Steve Nissen, it didn't really start really being used till 1850. So that's a little background how it was used, and it is pretty obviously common in Japan. And if you recall, a few weeks ago we talked about Ichimoku, which actually uses the foundation of basically candlestick patterns. So um, in a Western uh, trading, we use bars, and basically the bars, they represent what was the opening, what was the closing, what was the low of the day, what was the high of the day. So in this situation, it's the period. So I use the daily for now, so it will be easier for our conversation. But it could be 1 minute, it could be a tick, could be a week. So basically, we always have a high, low, open, and close. And the same thing when the open is uh, lower than close, or close is higher than open. That's why you usually have the green bar. The candlestick does the exact same thing. So they do have the, let's say we start with the green bar. When the closing is higher than open, then you have something called the space between those two is called the body, the candle's body. And if it's going up, it's in the green color. Then we have, they call it the high of the day, the low of the day, and that lines are called the shadow, they're called tails, they're called wicks. So basically, visually, I'm actually, believe it or not, more comfortable looking at candlesticks rather than the bars. That's how I feel comfortable. And then when they have it red, that means the opening was on the opening was higher than the closing, or the closing finished lower than the opening. So this is just basically a little introduction how the candlesticks work and visually. Usually they are red and green. And I have a little difficulty, when they call green, and we will, during our conversation, you will see just something, a candle being green or candle being um, red does not represent the bullish or bearish, and you will see why. It's visually, it tells you, okay, the sellers are in control for that moment, for that period, but that doesn't mean that you have to get bearish or bullish. I just want to show the first some of my favorite patterns, which comes from Forex channel, and I am, as you know, I always emphasize you have to know who you are. You have to know what type of a patterns you're comfortable with, what kind of a trader you are. And what I mean by that is a lot of people are more of a trend followers. So they go on a ride, they go on the train, and they follow the trend. So when things are going up, they are on the bullish side. And when things are going down, they're on the bearish side. My character is a little different. I am more of a contrarian. I do fade the moves. And what that means is I am pretty good in understanding the reversals. Because of that, so I have managed to use the techniques and the patterns which fit my characteristics. And that's why you've noticed I use a lot of mathematical patterns and strategies, such as, again, standard deviation, regression channels, Bollinger Bands, Fibonacci's, Keltner channels. So they're all mathematically oriented because I work with probabilities, and I am okay with finding the turning points. And the patterns that you see here, there most of these are more of a reversal patterns. And again, as I mentioned in the beginning, I wanted to share something that has worked for me. I will discuss some of the other things too, that depending on, again, your as far as your favorite kind of a characteristic of the trading. But for me, because I look at the reversals, it's things like hammer, which usually you can see it is looks like a hammer. It has a small body and long tail. And then we have inverted hammer, the same thing. It's just you can see inverted. I look at dojis, and the dojis are when there's no body. I mean, the opening and closing is the same. Very narrow body, long tails, or it doesn't have to be long tails, but they do have wicks, but very narrow body. So I use dojis a lot, and you will see during our conversation today, you will see some of the patterns that I use by using doji. Now, when you have a dragonfly doji, what that means, again, everything is visual, right? So in this situation, you can see it's almost like the wings, and it's on the top. So it's a dragonfly. On the other hand, you have something called gravestone doji, which is, it's like a gravestone, and basically the opening and closing was on the low of the day. So these are called dojis. There's a pure dojis, which I will discuss in a couple of slides. Then you have hanging man, which is similar to inverted hammer, or the hammer, but it is more of a very, you going the reversal when there is a uptrend. As you can see, inverted hammer is on a downtrend. The shooting star is, again, similar to inverted hammer, except the trend is up in this way. It's up movement, this is down movement. And then the other part is the bullish engulfing. And basically what it does, the engulfing, as it means that the second bar is really engulfing the previous bar, is bigger body, and that's what it's called, engulfing. So this is something that I use. Again, my characteristics is more of a reversal, more of a counter trend. So I look for extremes, and I like confirmation, and that's what I use dojis a lot. So a couple of my favorite, uh, again, patterns are, one is called bullish island reversal. And what it is, you will have a gap down. This is the doji, and it gaps up. So you can see it's an island by itself. Sometimes you will see this, maybe it's closer, the body is bigger. Something like this is called morning star. They all have like similar ideas. So all this is, again, it's a reversal, as you can see. So I look for that, or we could have a bearish island. So again, we have that this is a doji, gap up, gap down. So basically this was rejection. So whatever happened, the buyers did not have the force to keep it up, and that's how because in the reversal happened. Similarly, we could have smaller body in here. We could have close, not a gap. And you will see it similar to this. And we call that evening star. So these are reversal patterns. And again, I use them a lot. So here's doji, pure doji. So we have, this is not really dragonfly, but if it was up, open, and close was the same at the high of the day, it would have been dragon. But I look for long wicks or the tails and the small bodies because they indicate for me that there's indecision. And I like to know what is the conclusion of that indecision. And you shall see in our, will give you my 7 criteria or my 7 points that what I look for. And the most important thing I think out of this class that you should take is it's not about the candle itself, it's the second candle, which tells you the bias. So one lesson, if you want to follow up, is granted you understand this candle, but the bias, the direction comes from this candle. The movement comes from this, not this. This gives you the heads up. This prepares you for your next move. So we will discuss it more, but that's what I want to make sure you see it. The same thing you can see, we got the, I mentioned we had the island, but here we have a doji again. It's a morning star, we call it. And this is, now when you have something like island, but it wasn't doji, similar, small body, when it's so far away by itself, we call that abandoned baby. An abandoned baby, it doesn't happen often, it's rare, but it's a strong indication of the reversal. So when this, especially sometimes it goes even higher, gaps up, maybe there was a news came out and it was really maybe a rumor, and then it fizzles out the next day, and that's what's called abandoned baby. So you will see some examples. Yeah, you will see examples now actually. So I went back to our NQ, which is our NASDAQ futures. So as you can see, every week that I go, I look at the Bollinger Bands and the moving averages, right? So this is what our closing was today. But there's a couple of occasions I want to share it with you. Number one, as I mentioned, I look at dojis as, again, indecision. And also I want to see what is the next move. So here, what happened, this is in October, beginning of middle of October, and you can see we went above the Bollinger Band. That was a nice big green candle. So if you were looking at this by itself, you would have said, oh, this is great. We got a large, there's buyers are in, this is strong. Well, when we combine with other techniques and other indicators, you can see, well, we were outside Bollinger Band, so there is a warning right there. Then we get this doji, and what happened, that's indecision. And basically there was no buyers and sellers had not decided whether they're going to continue the trend. This is what I mean by the second candle. As you can see, what happened, the second candle, that was a red candle. And what that means is the buyers actually, when they came in, they could not hold, and then they ended up selling off. So there's 3 things I want to take into account right now. Number one, we were outside the Bollinger Bands. We have a doji indecision. Second thing is, you can see this is our confirmation. Now we are inside Bollinger Bands, and that tells us that sellers are in control. So if I want to put a trade in on NASDAQ, for instance, on this, whether I want to do futures, if I want to do options on QQQ, for instance, or if I want to play XLK, what I would have done, I would have gone short, or I would have bought put options, or I would have sold calls above high of this tail. So the high of the tail is the distribution. So this tail is distribution. So basically the technique that you will use is you will get into this trade with your stop loss, whatever you did, two or three ticks, I would use 2 ticks above the high of this doji. So, and you will stay in it till the reversal happens or till you hit your profit target. The way I do my stop losses, I use a trailing stop, is every time the next candle, for instance, I go back in this situation, if you want to be really conservative, you can go back to the previous candle and make your stop loss the high of the previous candle. So if I'm doing futures, because it's more, again, aggressive, if you're doing just QQQ, you can still keep the same, the high of the day. If you just wanted to short it, and options, you can just leave it at that. For futures, for me, I would use the trailing and then just continue. And as you can see, we had a nice orderly. And then what happens, we go to the 18-day moving average. We've had it 1, 2, 3, 4, almost 5 days of indecision again. And by themselves, they don't mean anything. They're the color indecision. But as you can see, then we broke down below the 18 days. In the meantime, as you can see, we were embedded. We actually, our stochastics confirmed that the sellers are in control. And basically, as we got from overbought going toward oversold, we broke under 18. And what is the first place when you break over 18? You go to the lower Bollinger Band and you go to the 100-day moving average. And that's what exactly happened. Look what happened here. We had another doji right on the 100 days, and we had this confirmation, the second candlestick, and that was our bullish signal with, again, our stochastics getting out of their embedded, going above 20. This almost looks like a morning star. We have this bar, and then we continued. We went from the 100-day moving average, and we went past 18 and went to the, again, to the next Bollinger Band. So basically, I just thought this is how I use it, especially in the futures, but also in options or stocks, you could use the same. But dojis for me are very important. The tails, you can see they are very important because the tails, either side, they tell me there is a distribution or accumulation. So the distribution means this, that buyers are being rejected. So they had all the power, for instance, here, and then they got rejected. One more thing, and again, these are in my 7 criteria, so you will review them, but every time you have a doji, let's say this is an uptrend, as you can see, the uptrend, 1, 2, 3, 4 candles were uptrend. Now we have a doji. Doji by itself doesn't mean that the trend is going to change. As I mentioned, this is the second candle. What you could do, actually, you could have had open here, and this could have continued. Let's say, again, especially because we are in Bollinger Bands, that kind of limited the odds. But let's say we were in the middle and we had the candle, actually this candle opened higher than the doji. So if the next candle opens higher after the doji, normally that means it will continue going up. If it closes lower, which in this case it did, that means it's going to go down. So that's another rule that I use. I don't think you see it often in the YouTube other things. It's like, so we use that doji as either continuation if the next candle opens up the next day, or if it opens down, that means it's reversal, it's going to go down. So that's what I use as an indicator. So I also want to share some of the patterns, general patterns, that just for your own information, some of the bullish, for instance, we talked about hammer and inverted hammer. So basically you can see there are reversals, and again, we talked about dragonfly and the um, bullish engulfing. There's a piercing, which is really the colors change, and then basically again it's a trend reversal. Morning star, we just discussed it, either doji or small body. And then I don't use the 3 white soldiers a lot. So Sometimes there's the white cloud they use. There's a dark cloud over. The rules of three happen. Sometimes we use five. This happens quite often in a forex. So I'm not, again, with these. Uh, that means the strength has come in. After 3 days, there's a rest. Sometimes after 5 days, there's a rest. I am, again, I want to emphasize the things that I use myself, which are mostly, again, the hammer and the doji, basically. So let's use an example. I went back and I looked at Best Buy. Something happened in August. And I mentioned to you about abandoned baby, which doesn't happen often, but that was interesting to, I found this, that you can see what I've done here. I also, it will be part of our 7 criteria, is I use the Hall moving average, which is a 20-day. So you can see this purple is the 20-day Hall moving average, which is more dynamic. And this blue line is just a regular, actually it's 21. Yeah, sometimes I use 21, sometimes these are 21. So this, the blue is just a simple regular moving average. So um, the idea is that the purple usually moves faster because, again, it's dynamics, it's weighted and it's exponential rather than just a simple. So I've used this. So you can see this candle, we gapped up and it was really by itself, and then it got rejected. So usually that's a good indication of the rejection of the, again, the buyers. And in this situation, again, we've been kissing that um, Hall moving average at 21-day. It's almost like a railroad track. We're going up, up, up. As soon as this abandoned baby happens, then we close under red candle. As you can see, there's a little indecision here, but we close, we gap down, and then you can see we basically sold off, and we were just floating around there, indecision, till the moving averages crossed. Now we looking at, these are the tails, again, doji indecision. um, we have dark cloud, big one actually here, big dark um, um, bearish. But then the reversal, you can see after this, second bar is green. So that means the buyers are actually in control. Again, rejection. And then since then, we've been going down. But right now, we are above the 20 all moving average. So there is stability coming in. So I will not short the markets because the RSI is getting, it's oversold, but it's getting a little strength. So we'll see what happens next. But right now, it is the moving average is flattening, although there's a doji. So we'll see what happens tomorrow. But this was the reason I want to just share with you that abandoned babies do happen. Um, this is just, again, more of a, you can look at the slides as far as like the bearish and bullish. It all depends, again, the positioning of where the candle is. So it's not just purely by itself, because if this candle was on the bottom and the low trend happened, that could be a reversal, even though it's red. So, and this could have been, on top. So generally they are reversal patterns. So I don't emphasize too much on the colors, but this is just a little bit in English, so you can have it for your own time, and you can read it through. Another thing is you can see quite often is the engulfing patterns. Basically, the second bar's body is stronger or bigger than, it's kind of gallops and engulfs. And if this green engulfing the red, that means the buyers are stronger than sellers. If the red engulfing the, the green, that means the bearish, the sellers are stronger. Again, I look at this more of a, again, if there was a reversal, there was the big news came and then there was reverse. Sometimes it happens after earnings. You can see this. So it's just sometimes it's confirmation. I don't use it as much, but it is something that I just want to share that with you. It is, again, if there was like a reversal, then I would put value on it. There's another one. This is a reversal. It's called bullish kicker. I mean, usually it's related to like big news. Something happens that there had been a maybe negative sentiment for a long time. Something big happens. It could be a takeover. It could be big news. It's like vaccination we hear nowadays. So what happens is after this like big candle, which was the sellers in control, it gaps up with a big body, and that's when it tells us that again you can see there's a reversal with the gap. The larger the gap, the stronger it is, and basically again this is more of a momentum oriented. So that means the reversal have happened. So that's is a good indication. So what I decided to do just give you a little more explanation of the kicker pattern. Again, it is more of a trend changing. It is the reversal, and because the attitude is changing, and then I also um, look at the volume, especially if there's a big volume that's in the picture, then that's good news. So it could be again, it could be a sector, it could be ETF, it could be in stock. So those are good. Again, you can see the common theme right now is all about reversals. One thing that it happens a lot in the forex, and they use that is something called kangaroo tail, and it is when you have these long tails, and then what happens is that the next candle opens completely away from the tail, and that's a strong reversal. Again, it tells us that the trend is going to continue in this situation to the downside. So it's a more of a bearish momentum coming in. So today I thought let's look at as an example, and I chose like let's say we had an inverted hammer in McDonald's. Now, as I mentioned, I don't like to look at it by itself, so I combine it with the different techniques. So it's like the West meets East. So what we want to do is say, all right, this is McDonald's today. What decisions do we make? We do have an inverted hammer here. So what happened, if you notice that McDonald's went and it hit its, in this case, 50-day moving average and got rejected. So that's why you see that tail. On the other hand, it's sitting on 20-day moving average. So we really are in a neutral zone. So right now, this hammer is not telling us anything. All it tells us that there was resistance at 50-day moving average. It is sitting on the 20-day moving average. So there's a tag, uh, again, competition. So this is a chart from Finviz. So basically we looked at that, and so I could not make a decision. I see, there's a major trend line is building here, a lot of indecision in this area. So basically it could go either way. So I looked at something else. We looked at the thinkorswim. As I mentioned, I like linear regression channels. Again, mathematically, I like to see, um, do we have confirmations? You can see again, there's a dark blue candle in this situation. It is that hammer. We are in the one standard deviation, so we're pretty close to the second standard deviation. So there's a resistance there. We still blue, but the momentum has changed from the hollow blue to dark blue. So that means the sellers are, have some control. But we're still above the trend line. We are above the mean. Our squeeze had changed color 4 days ago. You can see it's like 3 days ago. So the momentum is going up, although our waves are getting smaller. But again, by just looking at that, there's no decision to make. So the reason I wanted to show you this, not every candle that tells us gives us the certainty. So tomorrow will be interesting to see if you're going to be rejected, if the momentum is going to turn and we're going to go down, or we're going to break out. So that was my second test from different service. Then I also thought, well, let's look at, I mentioned to you about a Hall moving average and the regular in this situation, the 20-day moving average. And as you can see, we have broken above the Hall moving average, and then we broke above the regular moving average, but we got really rejected. So we broke above, it broke out. Remember, I do have my 2 candle confirmation whenever we break above the moving averages or a trend line, for instance. So I like to have, or Ichimoku clouds, when we go up, I like to have at least 2. So here we're almost getting rejected, but we're still above. So again, the RSI is in a midline, so 50 and over is strong. We like that, but when it goes below that, that means it's getting closer to oversold, but there's not much strength. I also wanted to show you what happened in March with McDonald's. As you can see, this is around March 23rd time. There's 2 things I noticed. You can see these long tails. So basically, again, the sellers really got rejected here. And after that, as you notice, once we broke above the 21-day all moving average, then we had a nice trend moving up. The RSI, you can see the divergence. So we basically, here, you can see this was the RSI of this, and here we are much lower, but the RSI is actually higher than the previous time in the end of February. So that told us maybe this is a time to consider what we need to, maybe we can accumulate McDonald's. The 4th thing is I use, and you have to, you can understand in a short, like a swing trading, I use 8-day exponential moving average. And it is pretty good, pretty good support or resistance. A lot of traders use that for 8-day. In this situation, I'm using 3, 8, and 21 exponential moving average. Again, this is a daily chart. And as you can see, right now we are above all 3 of them, and the 3-day being the shortest one. So again, there's an indecision. So all you can see is all of these, they indicate that this inverted hammer by itself doesn't mean anything right now. So we need the confirmation so that tomorrow we'll revisit this and see if the movement will go up, it will continue the strength with the moving averages, or is it going to be a reversal? And once we break below the 3, we're going to, the 8 and 3 are very much close to each other. Usually then it will continue. So, and the stochastics and RSI are kind of a neutral right now. Okay. So let me review my 7 criteria that I use for candlesticks. Number 1, the best time period, if you're using, again, visually you want to use candlesticks, I found it's daily. And that's what the rice traders use. It wasn't, they weren't day trading. They just want, at the end of the day, they wanted to see where they stood. And I found out that daily gives us a very good indication. Weeklies are good too. I mean, it works on every time period, which is really good. But when you think about, let's say, 5 minutes, and you combine it with like oscillator, which is like a 14 period, really don't have a big time horizon in that. And a lot of noise comes into the picture. So, but again, I use it. I just enjoy, and I really like to see things visually with candlesticks. So I use them, but if you want to use, the best usage is the same thing with Ichimoku. I found out is that the daily is the best of the time periods to give you the anchor, give you the guidelines. The second thing is that wicks and tails are very important. I mean, they tell you the story. So even if you want to do your stop losses, if you want to have the targets, if you want to have the actually stop buys, and you want to have get in, the tails, they tell you there's the accumulation or distribution, and again, visually they're very vivid. One word of caution, I found that years ago, and I don't know if it's happening now, but years ago when I used to do ETFs, trade a lot of ETFs, I had noticed that a lot of ETFs, and we didn't have as many as today, maybe that's one of the reasons. When you have a tail, it was interesting that the price would like to go back and visit the end of that tail. for whatever reason is. So usually tail is a rejection. So, but with ETFs, especially with the ags and other things like country ETFs, I used to notice that it doesn't happen often. It's just a side note. But anyway, the wicks and tails are um, um, pretty important. Again, visually you can see for accumulation and distribution, for stop losses. As I mentioned again, the second candle, that's what determines the bias. It's not the first candle. So even it's like the color is more important than the color of that candle. So you want to make sure you set your bias on the second candle. Doji patterns combined with the LRC, the linear regression channels, or Bollinger Bands, or I mentioned Fibonacci's and Keltner channels. All of those, they're good combinations. So they're good indicators for reversal when we are extended. So if I'm on the second standard deviation of linear regression channel and you see a doji, or you see inverted hammer, or you see again the rejection, that's really gives the odds more in your favor. The fourth thing I had mentioned again, the 8 EMA, I use 21, but 20 Hall MA combined with oscillators. I use RSI, but you can use stochastics, MACD. There are good confirmation moves as well. Now, as I said again, usually the opening after doji bar determines the direction. So if you have a doji and then the next day opens up here, the opening I'm talking about. So if it opens here, then usually the momentum is on your side, that it's going to go to the buyers. If it closes, if it opens less than the doji was, usually that's a reversal. So emphasize the opening, not the actual finishing the whole candle. I'm just saying opening gives the odds in your favor. And the seventh thing is uh, using classic patterns with candlesticks. It's a powerful combination. So with rectangle, for instance, a range bound, when there's a breakout, if you have a large candle breakout with a good volume, that tells you that this will continue. And I use an example. For instance, I went back, this is 2017, for instance, I used J&J, Johnson & Johnson. Here, you can see we were range bound, and the price moved about $6.50 up and down. So on this day, what happens in October, you can see we had this large candlesticks and it actually broke out. So as soon as we break above this, and remember, this is again, we have some indecision here. Once it breaks out, that tells you, look at the volume. With large volume, then it's a good time to actually get into this trade. Now, as you know, the rule of rectangles are, when we use triangles or rectangles, head and shoulders, we look at from the bottom to the top, and we see how much of a movement we've had. So in this case, it was about $6.50 up and down. So generally, the next movement, the next rectangle is going to move about $6 to $7. And that's what we did here. So if you're making a target, what you could have done, you could have gotten here and put the low of the, for instance, your stop loss, maybe low of this candle, and would have continued. In this case, in 4 bars, we actually did what it took us, I don't know how many bars, it's like 10 or 11 bars. It happened in 4 bars. So we had a nice journey of $6 or so. So that's a good combination. Again, we're mixing the classical pattern with candlesticks, and also again the objectives. So the rectangles are very good range bound, and they give you a nice target. Another thing I do is, again, being visual, sometimes when I look at the bars like this, I like to combine them and look at them visually to see basically where is the real story after 2 days. And you can see, all right, this was great. We had a lot of buyers, and then we had this rejection. So in reality, we have a long tail with small body after 2 days. So basically, that's how I can make a decision. And I can see, you know what, this looks really good. It gave me oh, there's buyers, and then this was not so good. So I see some indecision right now. Not that, oh, we're really bullish. So that's what sometimes, just for your own, again, information, you can use this to combine them. So basically, now that you know some of, again, my rules and my techniques, where do we find some of the candidates? Now, if you have Thinkorswim, you can go look the patterns, and also you can watch. I mean, you can have your own styles and the screen for them. Um, if you have TradeStation, any type of a really platform that you have, they offer you. I thought let's use a couple of the free ones. So where do we find them? One of them is again Finviz. I always talk about that. So I said, this is for today. Uh, I just want very liquid ones, and I want to see S&P 500. Or you can just choose, you can say, well, I want to have stocks at over $25, average volume over 1 million. But just for the simplicity, all you have to do, I use S&P 500, which all of them have options. Most of them have weekly options. And then you go to candlesticks, and you can choose any pattern that you want. I just used hammer. You can use dojis. You can use engulfing pattern. You can do any type of candlesticks that you want. You can choose it. And these are the candidates came up just for today. So for instance, that's just one way of screening. The second one is the stock charts. And for stock charts, again, it's a free um, service. They do have a premium one, both Finviz and this, but I don't think you need it. So basically, go to charts and tools. This is the main menu. As you scroll down on the right side, you end up seeing the reports and more. And there's something called predefined scans. So this does it at the end of the day. It's not live, so you have to wait till end of the day. And I would recommend, actually, the way I look at things is on weekends, if you have like half an hour, this is a good time to do some of your scanning and research. And basically, once you do that, this is again yesterday's close. So um, basically, it tells you some of the bullish reversal patterns, the bearish reversal patterns, the continuation pattern, the single candle like dragonfly, gravestone, hammer, hanging man, shooting star. So all of the things that we talked about, they actually give you from different exchanges. So in this situation, you have New York Stock Exchange, you have NASDAQ, you have Amex, you have over the counter, you have the Toronto Stock Exchange, you have Toronto Stock Exchange Venture, which is in three exchanges, I think Calgary, Vancouver, and Toronto. You also have LSE, which is a London Stock Exchange, and as well as NSE, which is the Indian Stock Exchange. So you can see there's a variety of stock exchanges that you could use, and you get some candidates. Again, some of my favorites are Evening Stars, for instance. There are very few, but when they do, they're pretty strong. And also Morning Star. You can see they're very rare, and I mentioned about Abandoned Baby. So basically, those are rare. But when they happen, they're pretty strong, especially if you combine them, like the LRC's linear regression channel. They're pretty strong. You don't need many of them. Again, the whole idea is to have the probability and edge on your side. So with that in mind, I didn't go into there's a Hakanaishi. That's um, actually a variation of the candlesticks, which actually puts the trends together. It marries like the candlesticks together. It's visually interesting that you do have access to it too in Thinkorswim, for instance. Just of interest of time, again, it's already almost an hour, so I didn't want to go too much in that. Maybe it could be one of our lessons of the week. I could put that in, but that's really good. And then, like you notice on Thinkorswim, the candlestick that we use is the TTM one, the TTM, and um, they marry candlestick with trend. So that's another variation. So with that, I hope it was useful and beneficial to you. And we can actually open up for the questions if anyone has any questions. Thank you, Sean. We can go ahead and do, we can stop
Sure.
recording and I can